All right, welcome everyone to this week's edition of Wealth Wednesday. We do have a little bit different of a setup this week. We're streaming through Zoom instead of an old service that we used to use. So let me know right off the bat if you guys can hear me. I'm sure there'll still be a little bit of a lag from when I'm talking live to when you guys see it. So just let me know if you can hear me, if the audio is sounding good, and then we're going to go ahead and get started. Today's presentation will be a little bit longer than usual, I think, just because there's a breadth of information to cover. And so if you're new to this group, the Retirement Mastery Group that's been growing fast lately, I think we're up to 275 plus members. If you're new to this, each Wednesday we do a Wealth Wednesday on some kind of topic related to retirement to teach you how to improve your retirement, okay? Whether it's tax planning, investment management, or talking about things like fees that we're talking about today. So each Wednesday we come in at noon and really just deliver a ton of value and a ton of content to you, or at least we hope we do so. So, all right, we're gonna go ahead and get started. I'm gonna go ahead and share my screen here and we'll get going. Okay, let me know if you can see my screen. All right, thanks, John. Thanks, Connie. Appreciate it. Awesome. So it sounds like everything's working. So today we're going to be talking about the 10 fees that you need to look out for and avoid. And fees are one of those things that it's the blocking and tackling of retirement. I think it's the number one way that you can improve, or the easiest way, I should say, that you can improve your retirement. And really today we're going to be talking about how to make sure you're not overpaying for the advice you're receiving. And obviously I'm in this industry. I am a retirement advisor. And so I think paying for advice is worth it. I think a lot of data backs this up, but what you want to be careful of is not overpaying. And we're going to talk about the impact and what that can have on your retirement if you do overpay. So let's get into it. Whoops. Okay, just right off the bat, I want to start with some thought-provoking questions. And I'm guessing I already know your answers to these questions, but they're going to come up again as we go through this presentation. Okay, so imagine today the federal government implemented an additional 25% income tax. So if you're in the 22% bracket, now you're in the 47% bracket, okay? Just across the board, they implemented a 25% income tax. How would you feel about that? Would you be thrilled, or would you be trying to look at what other countries you could potentially move to that would have a lower income tax? Okay. How would you feel about owning a CD that is offering a negative 2% interest rate for the next 3 years? Is that something you'd be comfortable putting your money into? Okay. What about, let's say you're going out and buying a car today. How would you feel about walking on the lot, looking through some cars, and then none of the prices were listed, and the salesman, the car lot salesman, were a little cagey. They didn't really tell you the price. They kind of beat around the bush and just say buy the car if you like it. Do you think you'd end up buying that car? And of course, in all three of these questions, these seem ridiculous to us. But as we go through this presentation, we're going to come back to these three questions. And I'm showing that I got Facebook running over here and it says the stream ended. I just want to make sure that. Can you guys still hear me? Okay, I think it's still working. Sorry, weird notification there. So, okay, thanks, Connie. So the important thing that I want to get across to you guys at the front of this is that the human brain isn't really wired for financial math. Okay, and I'm not saying your brain isn't. I'm saying just the human brain in general. I'm saying my brain, your brain, everyone's brain. And it's this idea of compound interest. Okay, and compound interest isn't something linear where you add one each day, so 1 turns into 2, turns into 3, turns into 4. Compound interest is exponential. So 2 turns into 4, that turns into 8, that turns into 16. Okay, returns compound on each other and increase faster than really our minds can grasp. Okay, and that's why, for this reason, fees are so important. let's say you're looking at an advisor that charges 1% versus an advisor that charges 1.25%. So 0.25% difference. Now, to most people, that doesn't seem like anything. Okay. That's a rounding error. It's really not going to make that big of a difference. But because of compound interest, 10, 20, 30 years down the road, it makes a massive difference. Okay. So example that I have for this, option one or option two. Okay. Option one, I'm going to give you just 1 red cent today, but I'm going to double it every day for 30 days. Okay. Option two, I'm going to give you $10 million today. Okay. So which would you rather have, option one or option two? Okay. Now you do some quick math on option one. 1 cent turns into 2 cents. 2 cents turns into 4. 4 cents turns into 8. 8 cents turns into 16. And, after 10 days, we got about $10. Okay. And so most of us can't fathom how $10, doubling 1 cent for 30 days can overcome $10 million. But in fact, if you chose option one, you'd end up about $737,000 ahead of just choosing the 10 million. And this is what I mean by compound interest. Okay. Our brains just aren't wired for this math. Doubling a cent every day, most people, and again, some of you might have seen this type of example before, so maybe you already knew what kind of the punchline for this, but most of us can't fathom that 1 cent would turn into over $10 million, but because of compound math, it does. And so this same principle of paying just a little bit more for a fee, overpaying a little bit more, can compound and have, obviously not this large of an effect, but an effect that compounds and grows much larger than most people think. So what does this have to do with fees? Well, I've kind of already alluded to it. Okay. Paying a little bit more in fees can have a huge impact. So this is just someone's situation. The numbers on the back end aren't very important. But this person's income, their assets are all, you can visualize this on the graph. This orange line here is their income goal for each year. This is their retirement moving through time. And then we see the different assets or the different income places that it fills in from. We have Social Security, retirement withdrawals, and whatnot. And so at the end of this person's life, they end up with $702,000 left. Okay. And so what would happen if this person paid just 1% extra in fees? Okay. Now, again, 1% doesn't seem like that much, but it has a huge impact. Okay. In fact, it cuts the money that they have left at the end of their life in half. And now something I would point out is this is in current dollars. So if this is 40 years in the future, this original $700,000 example, that might actually be $2 million in the current dollars in 2055, whenever this plan ends. So cutting in half might be losing $1 million that your heirs or causes you care about, they end up losing because of that extra fee. And so again, just to kind of start out, introduction, fees are a big deal and they have a huge impact. Paying just a little bit more in fees makes a huge difference down the road. So what fees might you be paying? One thing that drives me nuts with the financial industry is they are great at hiding fees. Okay. They're great at layering on different fees. So you think you're paying a lot less than you actually are. So common fees, and we've seen a lot of different fees. We're not going to cover all the different fees that we've seen through our practice, but here are just a few very common ones. Advisor fees. What are you paying for your advisor? Okay. Then that advisor is investing that money in something, typically a fund. What does the fund fee cost? Okay. Transaction fees if they're buying and selling. Platform fees. Sometimes if you're buying mutual funds, there are upfront fees. So right off the bat, you buy that mutual fund and you are at a loss, okay, because of that upfront fee. Annuity fee. So we're going to be going through each of these and kind of covering how to find these and what impact they might have and what you should or should not be paying for. So let's start with advisor fees. There's really 3 types of advisor fees, and there can be hybrid models, combinations of both of these. The first one is annual fee of assets under management. Okay, so this would be, I would say this is a very typical fee. It's how our business is set up. Okay. Whereas if someone comes in our door and they have $500,000 that they're going to invest, there is a fee charge on the assets under management each and every year. Now, these fees can range widely. And so let's say somebody has $500,000 and that annual fee is 1%. So in this given year, they're being charged $5,000. Okay, next year, let's say that 500 grows to 550. So next year's fee would be 5,500. Okay, so it's an annual fee on the assets that they have under management. Okay, very common type of advisor fee. I will say, and we're gonna talk about both the incentives and the drawbacks to each of these fees. The incentive here, I think, is most aligned with the client. Now, this can get carried away if the fee is too high, for sure. But if basically the advisor and the client's incentives are aligned in the fact that the advisor wants that money to grow as large as possible, and so does the client. The larger it grows, the more the advisor will obviously get paid. Okay, so and again, where the drawback to this type of fee is when you're being charged 1% or over. Okay, 1% is the average fee. I think that's way too high. Okay, and so if you're being charged 1.5% or something like that, that fee really adds up over the years. Okay, and that compound interest works against you because your retirement assets are growing bigger, but also the advisor's fee is. So you start with an advisor 20 years ago and their fee doesn't seem that big, and all of a sudden 20 years later, when your assets are a lot bigger, that fee seems a lot bigger as well. Number two would be hourly fees, and this is becoming more popular, but similar to how most lawyers are paid. Okay, whereas they set an hourly rate like $250 an hour, and you pay for the time that you meet with them and then the analysis time. Okay, so let's say that someone spends 10 hours preparing a retirement plan for you and then meets with you for 2 hours at $250 an hour. That would be $2,500 for the plan and then $500 for the meeting. Okay, and so depending on your asset range or what you're looking for, this can sometimes make sense to do hourly fees. Where I think the drawback is what's my incentive as an advisor if I'm being charged hourly? Okay, it's to complicate things as much as possible. It's to overcomplicate a situation, to spend more time trying to explain a complicated thing, because every hour that I analyze this situation or spend explaining it to you is an extra hour that I get paid. Okay, and I don't care if I was an hourly advisor, my incentives would I wouldn't care if your assets grew. I wouldn't care if you kept half your money in cash. Okay, because I'm being paid hourly. I don't care what happens with the assets. Again, just looking at incentives. I'm not saying that I don't care. Okay, but if I was hourly, that's the incentives line up. The third is commission, and these are going by the wayside and for good reason. So it's commission or upfront. So basically, when something like a variable annuity or a mutual fund is sold, okay, the advisor that's commission only gets payment immediately upfront, anywhere from 3 to 6%. Okay, and this is something I would recommend no client go with. And again, it's because of the incentives. For one, when you're paying upfront, that's coming out of your retirement savings. So if you have $500,000 and you pay upfront and it costs you 5%, well, right off the bat, you lost money with that advisor. Not to mention that advisor, what is their incentive on an ongoing basis? They already got all their money up front. So their incentive is to basically sell you that mutual fund and then delete your number from their phone or change their phone number so that they don't have to deal with you again and they can go sell the next person. And so this is something I would recommend nobody go with for those incentive reasons. Too many times I see somebody put in some kind of financial product and then never talk to again in that commission model. So simple question that I think everybody should be able to answer and deserves to be able to answer is, how much are you currently paying in fees for the advice and investing and retirement planning that you are receiving? Okay, how much is your retirement costing you from an advice standpoint? And it's a simple question we ask everybody that comes into our office, and I would say the majority of the time people are wildly off. They typically know their advisor fee, but it's all the hidden layers underneath that they don't really know. And again, I don't think that's the fault of the client. It's the fault of our industry, that financial advisor, for not fully explaining those fees or hiding fees. Okay. So if we just look at national averages across the board, and we look at that all in, basically that assets under management fee, we see on the chart here that we can see a couple different portfolio sizes. And the larger your portfolio size, on average, the less that you pay. Again, that makes sense. Okay. If we just zero in on this middle two targets right here, essentially $500 to $2 million of investable assets, we see that the average advisor fee is between 0.85% and 1%. Okay. And this is where most people stop, and that's all they're paying. Okay. Or all they think they're paying. But remember, there are fees on top of that. That advisor is taking your money and investing it somewhere. So that has to be calculated in as well. When we calculate it, the average basically fund fee, or in this example is underlying fee, we see that typically averages 0.65%. So somebody with $500,000 to $1 million, the average fee is 1.65%. So $1 million, that's $16,500 per year. Okay, that's a ton of money when you think about it, and especially depending on how much other advice that advisor is giving you, how many times you're meeting. Are they giving you $16,500 worth of value a year? Okay, we're going to talk about it. So if I want to put myself in your shoes, okay, obviously I know a ton about this industry. I know how advisors lie with statistics, try to layer these different fees on. So if I was retiring today, I'm putting myself in your shoes. What do I think is worth paying an advisor for? I would say right off the bat, behavioral coaching. And this is something that every human in the world can benefit from. Tony and I are always going back and forth talking about behavior around finances, our own finances, because we know as human beings, we tend to make a lot of biased mistakes. Okay. Human brain's not wired for this financial stuff. And so take an example like COVID-19, March of 2020. Okay. Markets down 30%. Everyone in the world is saying how we might turn into a Great Depression here. What did you do with your retirement savings? A lot of people took their retirement savings, put money on the sidelines, because I'd rather lose 30% than lose 80% if we see another Great Depression. Well, some solid behavioral coaching would have showed that now is not the time to take money off the table and put it into cash. Okay, if we look at, and again, we held a lot of webinars just like this on that behavioral coaching front. Okay, saying no, now is the time. The government created this meltdown. Now is not the time to take it off, take assets off the table. It's a time, if anything, to put more on. Okay, tax planning is another big one. It's something we talk about almost in every video. Building a forward-looking tax plan, RMD minimization, Roth conversion. Is your advisor doing these things? Because these are the things that are worth paying an advisor for. Retirement planning. Did they develop a retirement plan for you that shows income, that's tested through different environments? Are they optimizing healthcare? Are they Social Security planning for you and making sure you get the most from Social Security? Okay, once again, these are the things that are worth paying an advisor for. At the end of the day, we don't know what's going to happen to the market. I can't force the market to go up 10% this year. What I can do is make sure that you pay less in taxes, that you get Social Security right, that you save on healthcare costs. Okay, these are the things worth paying an advisor for. And then in some instances, there's an asterisk here, actual investment management. I don't mean taking your funds or taking your money and just throwing it in, American Growth Fund or some mutual fund. That's not investment management. I mean actually tax loss harvesting, tax gain harvesting on taxable accounts. I mean having a plan that changes with time, changes to your needs, changes to the economic environment. Okay, so these are the things that are actually worth paying an advisor for. Now, as we alluded to, what you invest in carries a fee. So this is on top of your advisor fee. Now, how are you or your advisor investing your money? If you're a DIYer, how are you investing it? If you have an advisor, how are they investing it? I will say the most common investment vehicle that I see, and I would say Tony can chime in, what, 90% of the plans that we look at are holding mutual funds. Okay. And mutual funds had a great, offered great value in the past. Okay. But they haven't really updated since. And now there's better, more democratized investment vehicles that I think offer a ton more value for retirees. So on the right-hand side here, I show basically the average mutual fund expense ratio by fund type. Okay, and this is assuming there's no load on the front end. So this would be an annual fee, and we see that across the board, you're paying between 0.6 and over 1% on top of your advisor fee. Okay, to be in these type of no load funds. Okay, so again, let's say you're in the average large cap no load stock fund, you're paying your advisor 1%. Well, you're also paying 0.86% to that mutual fund company. So really your overall fee is 1.86%. Okay. Now Tony's done a ETF versus mutual fund presentation before in this group. So I don't want to beat a dead horse, so to speak, but I will say the only benefit that I see for investing in a mutual fund in today's financial environment is if you are investing in some type of asset class that has very low liquidity. So let's say I'm not even sure if there are mutual funds out there like this, but let's say you're investing in collectible cars. Okay, so one, the amount of leverage that you can have investing $10,000 in collectible cars on your own is very low. You probably can't even purchase a collectible car. Okay. But if there was a mutual fund that had a fund manager that was purchasing all these collectible cars, you putting $10,000 into this big pool of money that they're now going out and leveraging other people investing with you, they can do a lot better job. For instance, if you need part of your investment out, let's say you put $50,000. If you're doing investing in collectible cars on your own and you need 10,000 of that original $50,000 investment, what are you going to do? You're going to sell half of the car, a portion of the car, the hood of the car? No, it's ridiculous. So you would have to sell that whole car. Whereas if it was a mutual fund that had collectible cars as their asset class, they could redeem a portion of your investment out. And so these are where mutual funds made sense in the past when, again, this landscape wasn't as democratized. Well, now there's things like ETFs. Okay. And when you invest in a mutual fund, you are giving your money to a fund that hires a fund manager. Okay. So that's where the majority of these fees come from, is you have to pay that fund manager to invest all of this money. Your money is pooled with other investors. Well, exchange traded funds basically eliminate that fund manager. Okay. And typically are just investing in indexes. Okay. And so, again, some people would bring up, well, I want a fund manager. Well, we're going to show in a second why that just doesn't add up when you look at the statistics for what value that fund manager has. The third way would be directly investing in stocks or bonds. And again, I would say mutual funds are by far the most expensive, as we see on the screen right here. I would say most exchange traded funds, you're looking at 0.25% or less typically. And then investing directly in stocks or bonds don't carry a fee. Okay. Now that being said, when you invest, there might be a transaction cost. There might be, depending on how liquid even that stock is, there might be some slippage on that, but we're not going to get into that today. So, and again, I could show 100 slides that look like this. It's taking a very common mutual fund like American Growth Fund of America, and it's just comparing it to an ETF counterpart. Okay. And so this is I think we're looking at 10 years here. American Growth Fund or Growth Fund of America is here in the orange. And then we have just a Schwab ETF counterpart here. Okay. Both will, again, if you look at the holdings, majority will line up. What's the difference? Fund fees. Okay. That's what makes this difference. As we can see, $10,000 would have turned into $46,000 with an ETF. With the mutual fund, it would have turned into, it looks like $41,000. Okay. So again, what's the difference? Something we'll talk about in a sec, cash drag, and then the fund fee. And again, we use Schwab quite a bit, but this isn't a pitch for us or Schwab or anyone. We can compare to another ETF, Spiders, S&P 500 growth ETF as well. Same story. Again, what's the difference here? It's the fund manager fee. Okay, it's the cash drags. Okay, so this is why we always harp on through these Wealth Wednesdays to beware of mutual funds. I don't see a reason why retirees today should hold mutual funds outside of that liquidity concern. Maybe Tony, if he has another reason that I'm forgetting, maybe he can add it into the comments. I just don't see a reason. Okay. Now there are a bunch of different mutual fund classes, from a class A, which you would pay an upfront sales charge on, but would have a little bit lower of an annual expense, versus a class C that would have you'd pay no upfront, but would have a higher ongoing fee. Okay. And so there's a bunch of different mutual fund classes. I don't think you should own any of them. Okay. Upfront fees rarely make sense just across the board. If you're taking $100,000 and investing it into a vehicle, and you're paying, let's just say, a 4% upfront sales charge. Okay. That advisor is getting $4,000 upfront. Okay. They're the only ones that are profiting from their relationship right off the bat, because now your investment is $96,000. So you have to climb out of a hole just to invest in a mutual fund, versus investing in an ETF, and that $100,000 right off the bat is growing for you. You're not underwater right off the bat, and you're paying a lot less on an ongoing basis. 12B1 fees. This is something the SEC is talking about doing away with. They tried to with the fiduciary rule. 12B1 fees are basically fees that you pay for the mutual fund to market itself, to try to get more people in the mutual fund, if you will. And now this is ridiculous right off the bat. I will say, when we make money, obviously we are trying to grow our client base as well. So no matter who you give money to, there's going to be some kind of marketing cost built in somewhere. But 12B1 fees right off the bat are, again, typically the cost of an ETF on their own, 0.25% often, that you are paying to essentially help the mutual fund company grow their assets, which is just ridiculous to me. Redemption fees, some mutual funds, when you sell them, they incur a cost. So it's just important to be aware of what type of mutual funds you have. And again, I would make a strong case you should try to get out of those and find better counterparts. And then cash drags. Cash drags are, again, a big reason that I have issues with mutual funds. So what are cash drags? Well, when you invest in a mutual fund, again, they are pooling all of your money together with other investors. Okay. And so the fund manager is then taking this pool of money and investing it in whatever type of asset class the mutual fund is marketed for. So they will hold large cash balances, because if one investor raises their hand and says, I need my money out tomorrow, they don't want to have to sell an investment at a less opportune time. So they hold cash as a buffer, so that people liquidating their mutual fund in a given day, they have a cash buffer that it won't affect the investments. It won't affect the tax status of the investment, because if they have to sell an investment at a less opportune time, they're going to have to pass capital gains on to the investor. Okay, if it's short-term capital gains, that obviously has some tax issues. And so what I want to show here is I just grabbed a bunch of large mutual funds. Okay, and from a bunch of different companies. So I'm trying to show you this is not a one-off thing, but it's a thing that I see every day. Okay, large cash balances. So let's take American Funds Balanced Fund, ABALX. Okay, they are holding 7.27% of cash. Okay, so you're putting $100,000 into that fund, and 7,000 of that, one, is not working for you to grow your wealth. Number two, you're being charged a fee on that cash. Okay, So you're owing, again, let's say this fund costs 0.6% a year. You're paying 0.6% on this 7% cash. And we can go to Vanguard at 3%. We can go to T. Rowe Price Balanced at 5%. We can go to Dodge and Cox Income Fund at 7%. These are huge mutual fund companies. And time again, MFS Value 1.3%. Again, that's a little better. But oftentimes I see people holding cash. Their advisor has them holding cash for reasons, for withdrawal potential reasons. But then I also see them holding a ton of cash in their mutual funds as well. This is costing you fees on money that's not being invested. So in a way, you're stepping backwards. Any money that's in cash in these funds, you are stepping backwards and guaranteed to be stepping backwards. Okay. Again, that common objection that I hear or have heard in the past is that the reason I invest in mutual funds is because I want a fund manager. Okay. I want a fund manager running my money. Well, the stats just don't back it up that that's a good idea. Okay. Outperforming is tough. Okay. Outperforming the market is one of the hardest things to do. Okay. And so the fact is most people or most fund companies just don't do it. Right here we have, this is from the S&P 500, their SPIVA report. They put it out quarterly. Look at all mutual funds and compare those mutual funds to an index. So if you're investing in American Growth Fund of America, they are comparing it to a S&P 500 growth index. Okay. And as we can see here, I'm just going to go to the 15-year period. Across the board, 70, I think low end 73 to 92% of all funds across the board underperform their benchmark. Okay. So this myth of someone managing, giving your money to a fund manager, expecting them to outperform the market and paying more to do so, it's just not backed up. It doesn't happen. Okay. Again, 70 to call it 90% of funds underperform. So if you're invested in 10 funds, let's say 7 of them are underperforming, 3 of the lucky ones are outperforming. I guarantee the seven underperforming are overcoming any benefit you get from the 3 that are outperforming. So once again, it's too hard to pick the winners and the losers. You're better off just investing in the index. Okay. And again, we can beat this horse all day. This just shows in blue median funds in a high cost quartile versus median funds in a low cost quartile. The gap is fees. Okay, funds with lower costs outperform those with expensive funds. It doesn't matter if we're talking U.S. stocks, taxable bonds. It doesn't matter if we were talking international, small cap, mid cap, across the board. This just keeps showing up. And again, it comes down to fees. Paying less in fees is the way to outperform. This is something I think we shared in the group quite a while ago, but not all fees are equal. Okay. Sometimes it makes more sense to pay, or it hurts you less to pay higher fees on a specific asset class versus another. So in this example, let's say we're in the year 2000. Okay. You have a stock fund, you have a bond fund. Stock fund is charging 1%. The bond fund is charging a little less at 0.75%. Okay. Well, yields or interest rates in 2000 were around 6%. So bond funds, let's say after the fee, you were earning a 5.25% yield. Stock funds, you were earning a 7% yield. Fees weren't that as big of a deal. Okay. I shouldn't say they weren't as big of a deal, but they're a lot less of a big deal than they are today. Why? Where are interest rates? Okay. So this is updated to the year 2020. Let's just assume fund fees haven't changed. Stocks, you're still looking at the kind of the same expected yield, paying 1%. We expect 8% growth from stocks. Okay. Not a ton has changed. Maybe somebody would argue against, but I'm just saying very simplistically, very broadly. Okay. You're earning a 7% yield on stocks, but where are interest rates? They've gone from 6%. Now let's say they're 1.5%. Okay. So that same 0.75%, you are giving up half of your yield. Okay. You're only getting 0.75%. That bond is earning 1.5%. You're paying 0.75% out to the mutual fund company. Okay. So you're paying a 50% income tax in a way, okay, to that mutual fund company. Okay. If your advisor is charging on top of that, you're guaranteed to lose money. that advisor is charging 1%, you are guaranteed right off the bat to lose 0.25% per year. Okay, so those thought-provoking questions about paying a higher income tax, a lot of people are doing it in their investment portfolios. If you're gaining 2% and you're paying away 2% in fees, you're paying 100% income tax in a way. Not to mention you have the potential to lose money in bonds as well. Okay. And then again, another buyer beware, variable annuities. These are the most popular type of annuities. I think they give annuities a terrible name, a rap. They're the most popular. They're also the most expensive. So if you layer on all of the different fees for a variable income annuity, national average is 3.61%. Okay. Basically, a variable annuity is often sold as you can get a guaranteed income stream, and then you get to invest that money in the stock market and hopefully grow that money. And so you could potentially have the guaranteed income, and then if things go really well, you could potentially pass on a ton of money to your heirs as well. And that sounds a little bit too good to be true, and it is. Okay. And how they overcome this great promise and are able to fulfill on both sides is they charge a huge fee. So they're able to fulfill the income promise, but then the growth never happens because of that huge fee. So in a variable annuity, it's just like investing in the market or in whatever investments you're currently invested in. Okay, you can duplicate that into a variable annuity, but you have this huge expensive wrapper around you now. You can lose money, you're tied to the market, you don't have any safety really. And so if you try to have safety in that variable annuity with bonds, well, these high fees are overcoming any interest you're getting on the bonds. If designated for income, they're not even great income options. Okay, because typically the income options give you a lot smaller income guarantee than if you just went to a normal income annuity that didn't pass anything on. And again, I don't think you should do either. Okay, I'm not a fan of income annuities just across the board. But I really don't think whether you are investing in a variable annuity for growth or income, I don't believe anyone should own a variable annuity. But they're the most popular. How do you know if you own a variable annuity? Typically, they're on your statement, you'll see something like VA, or it'll just say variable annuity somewhere on the statement. If you need any help, just let us know, and we could probably tell you pretty quick if you own a variable annuity. But this is something I don't believe anybody should own. Why? Because of the fees. Just comes down to the fees. So let's put fees in context. Okay, this is something we've shared quite a bit through a bunch of our presentations. If you've ever been to our engineering retirement income class or anything like that, your largest fees, just again, broadly speaking, for a 65-year-old in 2020 needing $75,000 of income with a $500,000 portfolio, we often say taxes will be your biggest fee or your biggest expense in retirement. Investment fees are number 2. Okay. I will say though, that for some, investment fees will grow to be your largest expense. Okay. The reason being is let's take the same example, but assume this person had $1 million rather than half $500,000. Well, double the fee there, and this person is paying something like $15,000 to $16,000. $15,000 to $17,000, okay, in fees. Okay, and so at that point, it's larger than the tax liability. Okay, so again, for you, fees might be your largest expense in retirement. So the easiest way to increase the probability of success in retirement, improve your standing in retirement, pass more money on to the next generation, is pay less in fees. Okay, let's look at fees relative to income. So in this example, we're looking at someone with an income need of $80,000 per year. 40,000 of that is coming from Social Security, which means they're going to need 40,000 coming from their assets. Okay, now we have some different retirement sizes right here. I probably even shouldn't have put this $500,000 on here, because taking $40,000 a year from $500,000, that $500,000 is not going to last that long. But nonetheless, I broke out a bunch of different fees. So from 1% all the way up to 2% in fees. Might even be paying more than that, but just for simplicity's sake, let's talk through this. Okay, so this person is taking $40,000 a year of income. Okay, let's say they have $1 million. Whoops. At 1%, they're paying $10,000. At 1.65, they're paying 16,500. At 2%, they're paying 20,000. Well, have you ever thought about this relative to your income? So that person is taking $40,000, and in red, you'll see basically the cost of their fee in relation to their income. And so look at this. If you're taking $40,000 a year for income and you're paying your advisor and fund fees 2%, you are giving away half of your income in fees. You're taking $40,000, you're giving away $20,000, really $60,000 of income is coming from your portfolio. Just a portion of that's going to your advisor's income, to the fund company's income, to American Fund's bottom line. Okay, the more you have in assets, the larger that fee becomes. If you're paying 2% on $2.5 million, that's 125% that you're paying out. You're taking less income in than you are paying out. Okay, and so again, this is just I'm trying to show the impact of fees in a few different ways. Okay, these things add up over time. So you want an income raise in retirement, the easiest way to do so, pay less in fees. Okay, if you're taking $40,000 for income and you're paying $20,000 out in fees, cut your fee in half and you get a $10,000 income raise. I would guess there's probably better ways that you guys have to spend your money in retirement than your advisor does. Now, again, I'm not saying no advisor is worth it, obviously. Okay, but it comes back to what is your advisor worth versus the fees you're paying versus what other advisors are out there that can accomplish that same goal. So oftentimes what I see now, we're a company that I think charges fairly reasonably, very affordably, and we do a lot of the tax planning. Okay, but I see other advisors out there that are also good at tax planning that always charge more for it. Okay, so for instance, if the average fee around this area is 1%, someone who is a full service shop that does a bunch of tax planning might charge 1.25% or 1.5%. And to some, again, we harp on how important taxes are and saving on taxes. You might think it's worth it to pay that extra amount in order for someone to do this tax planning. Okay, but think about this. Okay, if you're going to pay more for an advisor that also does tax planning, think about how much tax planning they have to do in order to overcome that extra fee. Okay, so let's compare someone that's charging 1% versus 1.65%. Okay, on $1 million, you're paying $10,000. Let's say that person doesn't do any tax planning versus $16,500 and they do tax planning. Do you know how hard it is to save this year alone? Do you know how hard it is to save $6,500 in taxes? I don't mean in taxable income. I mean in taxes. So at a 20% rate, that person would have to save or eliminate essentially what, like $30,000 in taxable income in order to save $6,000 on taxes. Okay, so it's almost impossible. Again, you can save it over time, but you're also paying that fee over time as well. So a Roth conversion today, you don't see that tax savings today, you see it down the road. But that fee is also being charged down the road as well. So my point here is just paying significantly more in fees. It's almost impossible to overcome it by tax planning. So tax planning is important. Again, I have on the screen something that we show in every one of our Maximizing Social Security classes. A tax plan is the number one thing your retirement planner should be doing. But if they're charging more to do so, it eliminates all the benefit of the tax planning. I would say the best tax plans that we've built, and again, I'm not saying compliance-wise, I'm not saying we can duplicate this for your situation. I'm not making any promises. But let's say we have someone that we save, our forward-looking tax plan save them $400,000 on taxes estimated throughout their life. Well, if they're charging more and that fee adds up to $500,000, you're better off not tax planning at all. Okay, better off going with a cheaper advisor. That's how important fees are. We harp all day on tax planning. Fees, again, arguably are just as important, if not more than important. So finding the total amount you pay or total amount of fees you are paying Well, imagine this. Imagine going on a car lot and asking for the price of the car and it not being there. Okay. Or not even seeing it on the website. You notice in that picture, the cost of the car is on every car. Imagine going to an open house that you didn't know the cost of the house. I'm guessing everybody, even prior to going to look at that house, knows the cost of the house. Imagine going to Amazon and the prices aren't listed. Okay, well, this is basically what most people face when they search for a financial advisor. Nobody puts their fees on their website. And I can tell you it's not because they want to surprise you later on with how low their fee is. Okay. So something that I would do if you want to know how much you're paying your advisor in a fee, first step is going and asking. And I would recommend doing this in person because you'll gain a lot more cues from their body language if they stutter than you would through an email. Okay, so ask them, how much am I paying in total fees? Okay, if they start with their advisor fee, you're paying me 1%. Ask the next question, what am I paying for fund fees? Oh, well, yeah, you're paying 0.5%, if not more for, okay, if you aren't getting a straight answer, I would recommend getting a second opinion. Okay, it's just too important. Okay, if you're starting to get a vibe that your advisor is hiding fees, they aren't giving you a straight answer. We don't accept this in any other area of our life. Why would we accept it in this industry? Just because it's become a norm? That seems ridiculous to me. Okay, so first step, ask your advisor. If you feel like you're not getting a straight answer, fee audits are something that we commonly do. You can definitely reach out to us, comment on this video below. I think you deserve to know the answer. And just in full transparency, I'm not trying to make a case for us. We post a ton of content on here. If you like what we have to say, we don't have to make a case. We educate a ton, but I would be remiss if I didn't talk about our fee as well and be fully transparent with our fee. So we charge 0.0 or 0.48% per year. Fund fees on top of that are typically between 0.03 and 0.07%. So all in fee, basically 0.55%. National average, again, depending on how big portfolio is, anywhere from 1.65% and above. And so, again, as you can see, huge fee savings. So when we talk about saving 1% on fees, there are a ton of ways to do so. Okay, so just kind of wrapping this all up, 10 fees I think everybody should avoid here. Overpaying an advisor. Okay, and this really comes down to, I mean, it's more of a multi-layered discussion, but what is that advisor offering you in value from a retirement planning, from a social security, from a tax planning, from all of those things we talked about before that you should pay an advisor for? What do they charge versus another advisor that offers potentially the same thing or less? Okay, that's how you know if you're overpaying for an advisor. Using mutual funds to invest. Again, I'll plant my flag. I don't think anybody should own a mutual fund unless for a liquidity reason in an alternative asset class. And I will say, I rarely see that being the case when I'm looking at client situations. They're investing in mutual funds to basically invest in the S&P 500, and they're paying way too much to do so. Paying transaction fees. Again, in this democratization of investing, transaction fees have been eliminated largely. Charles Schwab, TD Ameritrade, E-Trade, Hush Hush Robinhood. Okay, there's a ton of places that you don't have to pay a transaction fee anymore. So if you're continuing to pay transaction fees, I recommend looking somewhere else. Paying upfront loads. Never pay in order to invest. You never want to start a relationship with someone being underwater, if you will, or coming from behind. Okay, you invest $100,000 right off the bat, you owe 5%. You're down $5,000 right off the bat. Your advisor just made $5,000. Don't pay upfront loads. It just doesn't set up a great relationship with the advisor, and it doesn't put you in a good relationship. Owning underwater funds. So this would be if you own a bond that's paying 8%, and you're paying 0.5% to be in that bond, and then your advisor's charging 1%, you are guaranteed to lose money. That is an underwater fund. Nobody should invest in those. Okay, you're better off just holding cash outside of your investment accounts. Okay, cash drag fees. If you're investing in a mutual fund or a fund just in general that is holding cash, and I would say a cash drag for sure over 1% is pretty ridiculous. I know we try to keep cash drags We're pretty anal about it, very anally low. Owning a variable annuity. I don't think anybody should do it. Paying for outperformance. I think it's an illusion a majority of the time. And in fact, the data backs it up. 70 to 90% of the time, it's an illusion. So why pay for it? Paying an advisor only for investment management. So if all your advisor is doing is putting you in funds or even investing in stocks and bonds, okay, there are great platforms out there like Wealthfront, Betterment, that if you're just looking for investment management, you can probably do so a lot cheaper than paying an advisor. Okay, again, that's the democratization of investing. And then paying more for tax planning. I think tax planning is so important. Okay, we talk about it in every presentation we do, but don't overpay in order for tax planning. If it's, again, depending on your asset size, it would have to depend, but I would say if you're paying over, 0.1 or 0.2% for tax planning, it's likely eliminating all the benefit of that tax planning. Again, I say that very broadly, but in summary, don't be like this guy who's essentially lighting $1 million bill on fire as a stogie. Fees are the simplest way to improve your retirement safety. Okay, it's guaranteed. It's one of the only things in retirement that are guaranteed. You save a percent, that's an extra percent that's in your pocket. Okay, vast majority of advisors don't know the exact fee they're paying. Don't be one of those people. Okay, why do we accept this in this industry, but we don't in any other industry? Okay, and then if you're someone who, I've got the wheels turning from this presentation, and you're someone that, wants to dig deeper and know exactly how much you're paying, and you don't think you're going to get that exact answer from your advisor, comment below or private message either Tony or I, and we'd be more than happy to do a fee audit and get you the information that you guys need. So as always, you don't need more money. Okay. You need a better plan. You need to pay less in fees, keep more in your retirement. Active management, Bruce, that's something we'll probably talk about because I'm going a little bit long here. What am I? Yeah, I've been doing this for almost an hour now. So that's something that, again, kind of in that same vein of outperformance. Okay. Active management is a term, but how much are you paying for that active management? Okay. If that active management costs 1%, 2%, if it costs more, are you sure that that active management is delivering that outperformance? Again, across the board, stats show that they don't. Okay. And so earning an extra 1%, outperforming the market by an extra 1% is very difficult to do. Okay. But we'll probably do a more in-depth, I know Tony's talked about doing a full presentation on active management. So that's probably something we'll do in the future, but let me know if you guys have any other questions. I'm signing off, but I'm more than happy to answer any questions in the comments that you guys have. Thanks for watching. Have a great rest of the day.